Well, good morning, everyone. I see some familiar names on the call and also some new names, so welcome and thank you for joining us. This is Neil Sperling with Financial Markets. Hey, you're in for a real treat today. But before we get started, please know your lines are muted. If you have any comments or questions during the call, please enter those in the GoToWebinar Control Panel question area, and we'll address those at the end of the call. Also, at the end of the call, we will have a drawing for a $50 Amazon gift card, only to those who are in attendance. And please remember, you must be on the call to be eligible to win. So today our guest speaker is Mr. Joe Ross, Vice President of Sales Productivity and Business Development with AIG Life Insurance and Retirement. Joe says his secret to success is a combination of making complex concepts easy to understand, connecting ideas in ways that haven't been done before, telling stories that connect products and ideas to emotions, and presenting concepts with enthusiasm. Well known for his experience, insight, and motivational presentations, Joe's highly regarded as a keynote speaker across the country at various conferences. Joe's bio is available to download in the handout area of your GoToWebinar control panel. With all of his success, it's a good read, and I encourage you to check it out. Joe's personal mission statement is to inspire people to achieve more, and today's presentation should do exactly that. So with that, I'll turn it over to Mr. Joe Ross. Joe?
Thanks, Neil, and thanks to everybody at Financial Markets for this opportunity to continue to communicate this message. As Neil and I were talking earlier, he's been able to watch this presentation several times and just enjoys the opportunity to come back and see it again, because every time you see it, you pick up something more, and you'll see why. We're going to cover a lot of material in a short period of time. One of my mantras is that in the life insurance business, it's not about the products we sell, it's about the stories we tell. And you're going to pick up some stories today. You're going to want to take some notes on some one-liners, some ideas, some phraseology that you'll want to incorporate into your daily routine to be able to help your clients achieve things that they didn't realize were possible. Now, in today's presentation, you can see on screen the title of it looks like the overview of the Secure Act, the changes and opportunities. That's not what we're going to talk about today, as odd as that might seem. You see, the way this unfolded is that our advanced sales attorney was asked to create a presentation back in January when the Secure Act just came out. And everybody was clamoring to figure out what the Secure Act meant and what was in it. And so our advanced sales attorney created this presentation documenting all kinds of stuff that's in the Secure Act. Well, there's a lot of stuff in this presentation that I'm not going to have time to show you today, but it's interesting because as I saw this presentation for the first time back in January, I started looking at it and thinking to myself, you know what, some of this doesn't make sense. And some of it has to do with things that Neil was just talking about. It's connecting ideas that have not been connected before. There are things that are happening as a result of the Secure Act that are changing the rules of the game and changing the way things work. But there are things that I find that advisors simply don't understand about it because they're taking it basically at its face value. They read something in it, they say, okay, I like that, that makes sense. They don't think about what it means in its position to other concepts that are out there today. So you're going to hear a little bit about the Secure Act, but I've changed the title a little bit just for purposes of today. Instead of the overview of the Secure Act, I call it the Ironies of the Secure Act. And instead of changes and opportunities, I call it Contradictions and Conundrums. You're going to learn about things in the Secure Act that will leave you scratching your head, as I do mine, thinking, what were they thinking when they wrote that? And so get your pen ready, get your piece of paper ready, get ready to take some notes. Let's learn about some things in the Secure Act. What I'd like to begin with is focusing on IRAs, which was a big part of the Secure Act, especially as it relates to our business. So let me ask you something. Did you know that there are 3 things going on right now that will cause IRA beneficiaries to pay more taxes on the IRAs they inherit? Did you know that? Do you know what those 3 things are? Do you think it would be valuable to you and to your clients to know them? Probably would. So these are things that you wouldn't see just reading the Secure Act. You have to connect these ideas together to have it make sense. So let me start with the first one. So out of these three things, two of them are in the Secure Act. One of them is actually not in the Secure Act, but it happens to be going on right now at the same time. And so it's by coincidence that now we have not just two things from the Secure Act, but two things plus another. We have three things going on right now that will cause IRA beneficiaries to pay more income taxes on the IRAs they inherit. What's the first one? Well, there's this thing out there known as the Uniform Distribution Table. If you don't know what that is, that's the table of factors that are used to calculate RMDs from an IRA. All you basically do is take the previous year, December 31st IRA value, then you go to this distribution table of factors. You find the factor relevant to your age. So if you're 74 years old, you go to the 74-year-old factor, divide your December 31st value by that age 74 factor, and boom, there's your RMD for your 74-year-old. That's all there is to it. That's what's in this uniform distribution table of factors. Now, as long as I can remember, and I first started in the industry in 1978, so 42 years I've been at this, and as far back as I can remember, and even beyond 1978 when I started, I have never seen anything change in the uniform distribution table of factors. And finally, after all these years, Congress has recognized that people are actually living longer. So a new table of factors has been proposed. It's currently in the proposed stage. It's not in law yet. It's widely expected to pass before the end of this year. However, I have some concerns with all of the political things going on right now that it just might not make it through by the end of the year. If it does make it through by the end of this year, then it will apply to anyone who turns 72 years old on January 1st of 2021 or later. If for some reason they don't get this through before the end of this year, then it will become applicable to anyone who turns 72 January 1 of 2022 or later. But there's a couple of things to think about here. First of all, who cares? Who cares that there's a new distribution table of factors for calculating RMDs? Well, again, if you just read the Secure, or if you read things like this and take it at its face value, you think to yourself, well, wouldn't everybody be interested in knowing about this? You'd like to think so, but there's this thing out there that we've all heard of. It's called the 80-20 rule. You know the 80-20 rule, Roy. In fact, the 80-20 rule goes all the way back to the 1800s. There was an economist in Europe. His name was Vilfredo Pareto. In fact, the 80-20 rule in some circles is known as Pareto's law, just like the law of gravity is often known as Newton's law of gravity. So Vilfredo Pareto was assigned the task of studying the distribution of wealth in Europe in the 1800s. And what he discovered is that 80% of the wealth was in the hands of 20% of the people. And there in the 1800s became the beginning of what we know today as the 80-20 rule. Well, it applies to the wealth today as well. And what we know is that 80% of the wealth today is in the hands of 20% of the people. So what does that mean? Well, if you look at the statistics right now show that 82% of people over age 70 are already withdrawing more than their RMDs from their IRAs. Now, how can that be? Well, because they have small IRAs. These are the 82% of the people that are sharing only 20% of the money. They don't have a lot of money. So they might have an IRA that's worth 100 or 150 or 200, maybe $300,000 or $400,000, maybe $500,000. They think that's a big IRA. Well, think about this for a minute. There's another, I'll give you a little bit more history here. Back in 1994, there was a famous article published by a fellow named William Bengen. Some of you might know of this article. When William Bengen, he was a mathematician, and when he published this article back in 1994, he did all this Monte Carlo simulation research, and he unveiled what became known as the 4% rule. Now, if you take Bengen's 4% rule from 1994, which is still widely used today, and you apply it to a $500,000 IRA, what it says is you should only withdraw 4% in the first year of retirement. Well, 4% of $500,000 is only 20 grand. So if you have a $500,000 IRA, you may think you've got the world by the tail, but the reality of it is if you want a secure retirement for 30 years, you should not withdraw more than $20,000 out of that IRA. So take that, add maybe $10,000 or $15,000 of Social Security income, and you only got $30,000 or $35,000 to live on. How many people want to live on just $30,000 or $35,000 a year in retirement? Not many. So what's happening? Well, this 82% crowd is withdrawing 6, 8, 10, 12% per year from their IRA. And as a financial advisor, you're just hoping you can figure out a way to keep that IRA alive as long as your client is. But that's what's going on with 82% of the world. They don't care about what we're talking about here. Who does care? That's the other 18%, the people that have all the money. Now notice the statistics are very close to the 80-20 rule. 18% of the people, they care. Why? They have all the money. They have big IRAs, and they have lots of non-qualified assets too. And you know what that means? It means they're living on their non-qualified assets, and they're just letting their IRA grow and grow and grow. They're taking their RMDs out of it, and that's why this is important to them, that there's a new RMD table. But for all intents and purposes, that IRA is just a safety net to them. It's just a cushion. It's just going to sit there for the rest of your life. So it's interesting to note some of the things we're going to talk about today only affect this group of people. I call them your 18%ers. It's the people that have all the money. Now, let's talk about this for a minute. So there's a new uniform distribution table, and it has new factors in it. These factors reflect longer life expectancies. Well, Joe, how does that translate into more taxes for IRA beneficiaries? I don't see the connection. Here's the connection. It's a domino effect. The first domino that tips over is the new uniform distribution table factors reflecting longer life expectancies creates smaller RMDs. So that's a good thing, right? Clients in that 18% group don't have to take as much money out of their IRA because their RMDs just got smaller every year for the rest of their life. It's about a 2-year difference. So under the new rules, a 72-year-old will have about the same RMD that a 70-year-old would have had under the old rules, about a 2-year offset, reflecting longer life expectancies. So that means they don't have to take as much money out of their IRA. That's the first domino that falls. That leads to domino number 2. What's domino number 2? Well, if you don't have to take as much money out of it, that means there's going to be more money in that IRA, right? That leads to domino 3. That means that when the parents die, that IRA is worth more money. And that leads to domino number 4. When the kids inherit it, they're inheriting a larger IRA. Now, that seems like good news, and it probably is. But the bad news is when those children inherit a larger IRA, it tips over domino number 5. When they inherit a larger IRA, they're going to pay more taxes on what they inherited in that IRA. So that's the domino effect. This is an example that Neil was talking about, connecting ideas that haven't been connected before. The new uniform distribution table of factors is reducing RMDs, and it's going to cause IRA beneficiaries to pay more taxes on their IRAs, especially the children of those 18%ers, the people that have all the money. So that's the first one. Now let's talk a little bit more about IRAs. So when you think about IRAs, many IRAs come from 401ks. People retire, they do an IRA rollover from their 401k plan from work into their IRA. But some people keep working, and they keep working, and they keep working. In fact, they may work well into their 70s. And interestingly enough, the rules around 401ks say that as long as you're still working and contributing to your 401k plan, you can continue contributing as long as you want. As long as you keep working, you can keep contributing. The IRS basically wants to say, if you're a working person, you can keep contributing to your 401k. Well, what Congress noticed when they were rewriting this Secure Act is that IRAs are treated differently. So remember, the only money you can put into an IRA is from earned income, which means if you're contributing to an IRA, you're working, just like somebody who's participating in a company that has a 401k plan, right? But let's just say you don't participate. You don't work for a company that has a 401k plan. Let's just assume that you run this small family-owned business in a strip mall on the edge of town. You don't have a big company, and therefore you don't have a big 401k plan. And so you and your spouse are just contributing to your IRA every year. Well, prior to the Secure Act, prior to this year, you were not allowed to make any contributions to an IRA after age 70 and a half. So what did Congress do in the Secure Act? They repealed that. Now there is no maximum age for making IRA contributions. You can continue to make contributions indefinitely rather than stopping at age 70 and a half. Now this is wonderful news for your family-owned business that's, you know, in that strip mall on the edge of town where mom and pop really enjoy what they're doing. They don't see any reason to retire. It's kind of a hobby for them, but they want to continue contributing to their retirement. So they can keep on working and keep on contributing to their IRA to the extent that they have earned income. That's good news, right? Okay, that seemed really good, and it kind of synchronizes IRAs with 401ks. But there's another piece to this puzzle. With 401ks, not only could you continue contributing for as long as you continued working, but you also didn't have to take RMDs. So we know the RMDs used to start at age 70 and a half. If you were working for an employer that had a 401k plan and you were still contributing to that 401k plan, you didn't have to take RMDs out of that 401k plan. However, when Congress tried to synchronize IRAs with 401ks, look what they did. They did something that everybody thought was great. They increased the RMD age from 70 and a half to age 72. Now, again, if you just read the Secure Act and take it at its face value, you'd say, hey, that's good news, right? But again, who cares? Who cares that the RMD age has been increased to age 72? We're back to the 80-20 rule. 82% of the people don't care because they're already withdrawing more than their RMD from their IRA. So again, this is back to the 18%ers. The only people who care are the 18%ers. But here's where Congress had an oversight. They made a mistake in the Secure Act. And in fact, there's a new proposed version, an update to the Secure Act that's just been proposed. It's a bipartisan proposal by a Republican and a Democrat. They want to increase this RMD age to age 75. We'll see if that gets through or not. But as it sits right now, the only people who care about these increased RMD ages are these 18%ers. But now take this into consideration. Let's just assume you've got a client or you know someone who's running that family-owned business on the edge of town in that strip mall, and they enjoy their work and they want to keep working well into their 70s. They're 74 years old. They want to contribute to their IRA. Can they do it? Yes, because they can continue making contributions indefinitely. What's the bad news? They still have to take RMDs. Remember, they're 74 years old. So let me ask you something. What is the maximum contribution you can put into an IRA? Well, if you're over 50 years old, you can put in $6,000 plus a $1,000 catch-up provision. So this client of yours who can contribute indefinitely, working in that, you know, family-owned business in the strip mall on the edge of town, they can put $7,000 into their IRA. But guess what? If they have a $200,000 IRA balance, just to pull a number out of the sky and give you some perspective here, the RMD on a $200,000 IRA is, guess what? About $7,000. So what do you end up with? This client running this family-owned business on the edge of town is now able to put $7,000 in at the beginning of the year, but guess what? They got to take that $7,000 right back out at the end of the year because of their RMDs. And that's what would happen if they had a typical $200,000 IRA. So this is where Congress blew it. They forgot to notice that when they set up this new age for bidding RMDs, they should have said, as long as we're synchronizing this with 401ks, if you're still making contributions to your IRA, you don't have to take RMDs until you stop contributing. That would have synchronized it with 401ks, but they forgot that piece. So now you're going to have those business owners who are putting money in and they're taking money right back out again. IRA contributors, people working beyond age 70, this is going to be a big surprise to them that they can contribute indefinitely, but they got to take the money out. But then we get back to our first question. How does this increasing the RMD age to 72, how does that create higher income taxes to IRA beneficiaries? I don't see the connection there either. Well, it's another domino effect, because if you take one of those 18%ers, let's say that this 18%er has a $1 million IRA. If you have a $1 million IRA, your RMD at age 72 will be around $37,000. Your RMD the next year, well, let's go back to age 70 and a half. if you were 70 and a half under the old rules, your first RMD would be about $37,000. Your second RMD would be close to $40,000. You put those two together, in those first 2 years under the old rules, your client would have taken RMDs of about $75,000 on a $1 million IRA. That's what would have happened to your 18%er client. But now, because the RMD age has been raised to 72, guess what? They get to leave those RMDs in there. That leaves an extra $75,000 in their IRA in their early 70s. And now they live another 10 or 15 years into their mid 80s and they pass away. Well, what happens? That $75,000 grows. And over 20 years' time, that $75,000 could be worth maybe another $200,000. So the good news here is that the IRA increased in value by $200,000. And that's going to be a nice additional inheritance to the beneficiaries, right? Yes, it is. However, when the beneficiaries inherit an extra $200,000 and they pay 40% income tax on it, that's going to drive an additional $80,000 of additional income taxes. How many of you want to be sitting down next to your client's beneficiaries as they write a check to the IRS for an extra $80,000 for every $1 million of IRA they inherit? If they inherited $2 million, they'd write a check for an extra $160,000 to the IRS. I don't know where you come from, but where I come from, $80,000 is a real number. There's people I know who would not want to write that check. Do they see that coming? No. So what's the domino effect here? We have the same thing as before. Domino number one is that pushing those RMDs back leaves more money in the IRA. That leads to domino number two. There's more money there when the parents die. That leads to domino three, a bigger inheritance to the kids. And that leads to domino number four. We've got more income taxes when the kids inherit the IRA. That's what's happening here. So now you have two things going on that are causing IRAs to increase, or IRA beneficiary taxes to increase. What's the third one? The third one is we've lost the ability to do lifetime stretching. So these 18%er children who used to inherit these large IRAs and they could spread the distributions out over their entire lifetime. Well, what's happening here that my screen's flashing? Sorry about that. We'll try to get that to stop. But these kids who used to be able to stretch this over their entire life expectancy have now lost that ability. In fact, for IRA beneficiaries, for all intents and purposes, RMDs are gone. They don't have any RMDs. What they have to do is take all the money out in 10 years. The IRS doesn't care whether you take it all out in the first year, the third year, the 8th year, or the 10th year. They don't care if you take out a little bit every year, as long as all the money is out of the IRA and fully taxed within 10 years of inheriting it. Well, okay, a lot of people don't understand what that means, but what does that mean? Well, that means a lot of people are going to sit on that inherited IRA. I inherited an IRA from my parents for $1 million. I'm going to sit on it for 10 years because I don't have to take any RMDs and I can benefit from that tax deferred growth. But what does that do? I'm going to show you a chart here. And with this chart, what you're going to see is what happens to a $1 million inherited IRA for a beneficiary that chooses to sit on it. So here I've got an IRA worth $1 million. It's inherited by a beneficiary. Let's just say they're 50 years old when their parents died in their 80s. So a 50-year-old inherits this $1 million IRA. Now what's going to happen? They're going to sit on it for 10 years. Now I'm going to assume that it grows at a 5.25% growth rate. I picked that number for a specific reason. I'll explain why in just a minute. But when we grow that $1 million at 5.25% growth rate, at the end of 10 years, it's worth $1,668,000 at 5.25%. Now what's going on? Well, this client is 60 years old. What do they have to do? They have to take their earned income, put that on their 1040, and then they have to take this $1,668,000 and put that on their 1042. Question is, what tax bracket do you think that's going to get hit with? Well, that's a good question. I don't know what tax rates are going to be in the future 10 years from now. So let's just ballpark it based on something we know today. Let's just use a 40% state and federal combined tax rate. What happens when you take 40% tax rate and apply it to $1,668,000? Well, the taxes are $667,000. When you subtract that out, where do you end up? You end up where you started. You have the same $1 million after 10 years that you inherited 10 years earlier. So what do you have here? This is the moral of the story. your IRA beneficiaries are going to pay so much in tax that if they sit on this IRA for 10 years, they're going to give all of the growth to the IRS in the form of increased income taxes on that IRA. Do you think they're ready to do that? Do you think they realize that after 10 years of growth, they're going to end up right back where they started from? No, the beneficiaries don't realize this. And in a simple graph like this, you can help them understand the implications of this tax. You can talk to your clients about it regarding their kids who are going to inherit it. Or if your client is not the parents, your client is the kids, have this conversation with those kids. Now, when you're talking to those parents, this is all a problem, right? This is an issue. In fact, we talked about 3 things that are causing IRA beneficiary taxes to increase. Your clients are going to be affected by all 3 of them. They are going to be affected by the new uniform distribution table of factors. They are going to be affected by RMDs being pushed back to age 72, possibly back to age 75, which will make the problem even bigger. And then the lost ability to stretch over their lifetime, so now they have to take it all out in 10 years, all of which is driving more tax. If they'd have paid tax in the first year, they only would have paid $400,000 in tax at a 40% tax rate. But now they're going to pay $667,000 tax instead. That's an increase. That's what we're worried about. So as a planner, what can you do? What kind of advice can you offer? Well, let's offer some solutions to these clients. What could you do? I have a couple of ideas you can consider. One is called IRA Tax Offset. Why do I call it IRA Tax Offset? Because here's what we're going to do. We've got this IRA. Let's just say it's a $1 million IRA. We know that the income taxes on that IRA, if they paid taxes on it as an inheritance, let's just assume for easy math, they paid tax in the first year, would be $400,000. What are we going to do about that? Here's my favorite line. You approach this client, you say, Mr. and Mrs. Jones, when your children inherit that $1 million IRA, they're going to pay a lot of taxes on that. Help them understand what those taxes are. And then say, Mr. and Mrs. Jones, let me ask you something. If we could hire someone else to pay the taxes on that IRA inheritance so that your kids don't have to, would that be something you'd be interested in exploring? This might be a one-liner you want to add to your conversations. Mr. and Mrs. Jones, if we could hire someone to pay the taxes on that IRA inheritance so that your kids don't have to, would you be interested in exploring how we could make that happen? And of course they would be interested in exploring. Now, who can you hire to pay $400,000 of income taxes when the parents die? Ta-da, we can hire a life insurance company. How do we hire a life insurance company? We buy a life insurance policy. How big's the death benefit? It's $400,000. And now when mom and dad die, what happens? The kids inherit the $1 million IRA. It's fully taxable. They use the $400,000 life insurance death benefits to pay the income taxes, and they keep the entire value of the IRA. Now you say to yourself, but Joe, what if they inherit that IRA and they let it grow for 10 years to the point where it's worth $1.6 million? Well, now the taxes are going to be about $600,000, not $400,000. Well, guess what? If you took this $400,000 life insurance policy and just put it into an account and grew it at 5.25% in my example, guess what it's worth in 10 years? That life insurance death benefit is worth $600,000. So whether they pay the taxes in the first year or whether they pay the taxes in the 10th year, this $400,000 policy does the trick. Now, I like to call this solution my 1% solution. Why? Because the premium for this life insurance policy is around 1% of the value of the IRA. So if your client has an IRA they're inheriting worth $1 million, what's 1% of $1 million? That mathematically is about $10,000 per year. Okay, your client's going to say $10,000 a year for a life insurance premium? My goodness, that seems like quite a bit. But what have you just saved? You just saved your beneficiaries $400,000 in income taxes. So you ask your client, Mr. and Mrs. Jones, how many years, you're 68 years old now, how many years would you have to pay $10,000 a year before you pay more than $400,000 in life insurance premiums, which is what your children are going to pay in taxes? And they'll realize, they'll say the same answer every time. They'll say, we won't live long enough. We won't live long enough to see that happen. So they can see that this solution is going to work out to their advantage. It's an easy solution to describe, an easy solution to implement. Just buy a $400,000 life insurance policy while they're young in their 60s, and they can afford it. They're more insurable. The premiums are lower. Underwriting is easier. Get them in their 60s. The second solution I'll talk about is tax elimination. There's a little story that goes behind this one. Tax elimination is for those those clients that want to give something back. And this is so often true of your high net worth clients, those 18%ers. They've got the money and they want to leave the world in a better place after they're gone. They want to pay it forward. They want to give back. And so I find that in the vast majority of cases, wealthy people are going to leave something to charity after they're gone. How do you know? You ask them. So put this into your question and answer storyline. Okay, imagine how this plays out. Hey, you say, Mr. and Mrs. Jones, are you planning to leave anything to charity after you're gone? And they say, sure we are. Yeah, we've talked about that a lot. There's a couple of charities that we care about. And I ask the second question, do you have that written down somewhere? They say, what do you mean? I said, do you have it documented that money's going to charity after you're gone? And they'll think for a minute and they'll say, yeah, well, yeah, we do. We put that in our wills. That's what we did. Our will, it makes sure that money's going to charity after we're gone. That's the answer you're going to get almost every single time. And what should happen when you hear your client say that their will or their trust is being used to give money to a charity at their death? They just told you that a charity is going to receive non-qualified assets. What do most non-qualified assets get at death? That's right, they get a step up in basis at death. So a charity is going to inherit non-qualified assets that get a step up in basis at death. Now, normally step up in basis at death is used to reduce taxes. Does the charity need a step up in basis at death to reduce taxes? Well, no, they weren't going to pay taxes anyway. They're a charity. So literally, and this is happening every single day with 18%er clients, they're leaving non-qualified assets to charity, which means they're giving away one of the greatest tax benefits in the IRS code, and it's called step up in basis. And all of those assets would have gotten a step up in basis at death. Meanwhile, you ask them, who's the beneficiary of your IRA? And they'll tell you it's their kids. So you say, let me make sure I have this straight. We're giving non-qualified assets to charity so that they can get a step up in basis that they don't need. And we're leaving your IRA to your kids so that they can pay tax on the whole kit and caboodle. Do I have that right? Your clients will say, yeah, that's what's happening. Well, how hard would it be to flip those two around? What happens if we give the IRA to charity? Does the charity pay any tax on it? No, they're a charity. So they inherit the IRA income tax free. And now what do? You take those non-qualified assets and give them to your kids because they'll get a step up in basis when you die, which means they can sell those assets after you die and they won't pay any income tax either. And we've just wiped the government out of your inheritance. Who's happy here? Your client's happy because they were able to make a difference and pay it forward. They left money to charity they care about and they left money to their kids. The charity is happy because they received an inheritance that they don't have to pay any income taxes on because they're a charity. And the kids inherited non-qualified assets rather than inheriting a fully taxable IRA. So the kids are absolutely delighted because they didn't have to pay any taxes either. Now, is there anybody in this story that's not happy or wished they would have gotten something more? The answer is yes, it's the kids. Because the kids are happy that they didn't have to pay tax on the non-qualified assets, but the kids kind of thought they'd inherit that IRA too. And lo and behold, it went to charity. How do we let the kids have their cake and eat it too? That's where this tax elimination strategy comes in. So what we have is our IRA. What are we going to do with that IRA? We're going to give that IRA to your favorite charity. So we got a $1 million IRA. We got $1 million goes to your favorite charity. If I can spell with my mouse, we'll just make a little note here. So your charity is going to get $1 million income tax free. What are we going to do for the kids? We're going to buy a life insurance policy. How much is that life insurance policy going to be? It's going to be $1 million. And now what are the kids going to inherit? The kids are going to inherit, sorry, my drawing didn't work very well there. The kids are going to inherit that $1 million life insurance policy. Now what happened? Charity got $1 million income tax free. Kids got $1 million life insurance policy income tax free. Consider what this just did for your client. Before you had this conversation, they were going to leave their IRA to their kids. Their kids were going to inherit that $1 million IRA. They were going to pay $400,000 in tax. They were going to net $600,000. What did we just do? We just created an inheritance that's $1 million to charity, tax-free, $1 million to the kids, tax-free. That's a $2 million tax-free legacy. We just went from $600,000 to $2 million in tax-free legacy. Now I call this my 2% solution because the premium for this life insurance policy, this $1 million death benefit, is typically less than 2% of the IRA value. Well, what's the 2% of $1 million? That would be about $20,000 per year. And your clients are going to say, wait a minute, we want to pay a $20,000 life insurance premium? Well, Mr. and Mrs. Jones, let me ask you something. We just increased the value of your legacy by $1.4 million. How many years would you have to pay $20,000 a year before you pay more than $1.4 million in life insurance premiums? They automatically know they won't live long enough to see that happen. So this is an incredibly powerful solution. So you've got your 1% solution with your tax offset, a 2% solution, tax elimination, and I have another 1% solution I call spousal Roth conversion. How does that work? Well, in that scenario, it works very much like tax offset. But in tax offset, we bought a $400,000 life insurance policy so that it could pay the taxes for the kids. What I'm going to do in this spousal Roth conversion scenario is buy a $400,000 life insurance policy so that when I die, my wife, Mary, can use the $400,000 death benefits to pay tax on a Roth conversion. So here's what I'm going to do. Mary's 3 years younger than I am, and she's female. She'll probably outlive me by 10 years. So here's what I'm going to do. Mary, I bought a $400,000 life insurance policy. When I die, Mary gets the $1 million IRA. She rolls it over into her own spousal IRA account and immediately does a Roth conversion. That $1 million Roth conversion is going to cost $400,000 in income tax. Mary's going to pay that $400,000 of income tax using the life insurance death benefits from the policy that I already have. Now, what does Mary have? She has a $1 million Roth IRA. Mary doesn't have to take any money out of it because there's no RMDs. If she needs access to it, the money's income tax free to her, and anything that's left in the account when she dies goes to the kids income tax free. Let's just say that the kids inherit that $1 million IRA. That is now a Roth IRA, and the kids sit on that for 10 years. We know what it's worth at the end of 10 years. It's worth $1.7 million. And now the kids have to take the money out of the account, but because it's a Roth IRA, guess what? They pay no tax. So the kids just inherited $1.7 million income tax free. This is another 1% solution. So there's three great ideas that you can offer to your clients that own the IRAs that can offset, eliminate, or eradicate all of the tax associated with the IRA. What if these parents aren't your client? What if their children are your client and their children just inherited this $1 million IRA and they're worried about what they're going to do next? Well, let's talk a little bit about Roth conversions. When we talked in the previous example about my spouse, Mary, doing a Roth conversion, what happens when she does a Roth conversion? She pays tax on the entire value of the IRA in order to convert it to a Roth. Well, under the new Secure Act, my beneficiaries are going to have to pay tax on the entire IRA balance. Just like when you're doing a Roth conversion, you pay tax on the entire IRA balance. The problem is these IRA beneficiaries, since they have to pay tax on all the money anyway, they'd love to do a Roth conversion, but the tax code says that they can't do a Roth conversion. So what are they going to do? They're going to pay tax on all the money, and they're going to put it into their ordinary non-qualified account, and they're going to pay taxes on that money as it grows for the rest of their lives. That's what the vast majority of beneficiaries are going to do, unless they talk to you. See, they can't do a Roth conversion, but we can give them something even better. What do? The idea is this. Take that IRA inheritance, split it up into 10 equal parts. Let's just say that it's a $1 million IRA. 10 equal parts would be $100,000 a year for 10 years. Add some growth to that just because of interest earnings. Let's say it's $110,000 a year that they could take out of that IRA to liquidate it over 10 years. They got to pay tax on all that money every year. So that $110,000 a year, let's just say after tax turns out to be $80,000. What does your client do with that $80,000 instead of putting it into their non-qualified portfolio and paying taxes on it for the rest of their life? They take that $80,000 a year and they use it as a 10-pay premium into a life insurance policy. What happens? I'll tell you what happens. The money goes into the life insurance policy on an after-tax basis. just like a Roth IRA, just like a Roth conversion. The money grows without any taxes, just like a Roth IRA. There's no RMDs, just like a Roth IRA. They can access the money during their retirement income tax-free, just like a Roth IRA. Just a second here. See what my problem is. All right. I think we're back. All right. So the money can be accessed during their retirement income tax-free, just like a Roth IRA. And any money that's left in that death benefit goes to their beneficiaries, income tax-free, just like a Roth IRA. So the money goes in like a Roth, it grows like a Roth, it comes out like a Roth, it distributes to the beneficiaries like a Roth. Putting the money into a life insurance policy gives your clients essentially the equivalent of a Roth conversion. But they can also do something in a life insurance policy that they can't do in a Roth conversion. And that is they can purchase an indexed universal life. And what's the beauty of that? Indexed universal life is the only place in America today where your clients can have upside market potential without downside market risk. They can't do that in their non-qualified portfolio. They can only do that in indexed insurance products, indexed life insurance and indexed annuities. So do a 10-pay distribution into life insurance. Why would you do life insurance instead of the annuity in this example? Because you have tax-free access and tax-free distribution to the beneficiaries during your retirement and after you die. So a wonderful solution, a great opportunity for IRA beneficiaries. In fact, they could do both of these things. They could inherit a Roth IRA from their parents and take 10 distributions and convert it into a life insurance policy where they'll never pay taxes again. The combinations are wonderful, and the things that you can advise your clients to do are fantastic as a result of the Secure Act. Let's focus on a couple more contradictions and conundrums. Now, hopefully by now you've written down a question or two that we can talk about at the end, but let's talk about some other contradictions and conundrums inside the Secure Act. Here's one of my favorites. The Secure Act says that you can make student loan repayments from the money in your 529 plan of up to $10,000 per year. Now, the question is, people read that and thought, hey, that's great. What a great way to pay down student loan payments. But let me ask you something. Will this ever happen? I don't think it will. I'll take myself as an example. I don't consider myself to be unusual. I'm a parent like you are. I've got kids. When my kids were born, I started funding 529 plans. Those two young kids are now in college, and I'm withdrawing money from that 529 plan. So the money I put into that 529 plan, that money was earmarked to do what? That's right, pay education expenses. So the question is, why would I tell my daughters to take student loans to pay education expenses if I still had money in my 529 plan to pay education expenses? You see, it doesn't make any sense. So what I'm going to do is what most parents do. I'm going to continue to take withdrawals from my 529 plan until when? That's right, until it's empty. When the 529 plan is empty, then I'll go to my daughters and say, hey girls, it's time to start taking some student loans. The 529 money is gone. Now, think about that for a minute. Since the 529 plan has been emptied out, how do I make student loan repayments from my 529 plan? You can't, because there's no money left in the 529 plan. And this is the way the world works. So they put the provision in there, but you scratch your head and wonder, what was Congress thinking when they said this? Why did they put that in there in the first place? Nobody's going to do this, but there you have it. It's a contradiction. It's a conundrum. What's another one that's interesting in there? There's been this thing for a long time, back to the 1980s and 90s, called the Simple IRA. It was designed to provide small businesses the opportunity to create retirement plans for their employees. Well, apparently that isn't good enough. There's not enough employers doing simple plans. So Congress in the Secure Act said, let's create a new option. Let's call it the 401k multiple employer plan option. That'll get people to do it. And in fact, we'll give them tax credits as an incentive to do it, to make this work and get them involved in it. Well, let me ask you something. How complex is a 401k plan? How complex is the regulation and administration of a 401k plan? You know, I've got a friend of mine who's a pension TPA. He administers pension plans for small businesses. He tells me that it is not at all uncommon for the annual fee for evaluating a 401k plan to run $10,000 to do the annual audit on that 401k plan. Well, what Congress said is if we can make this a multiple employer plan, we can spread that audit cost across all of the employers involved in the plan. But in order to do that, you have to commingle your retirement money with all these other employers you know nothing about. And you have to find somebody to administer the plan. Is that really going to be less expensive? And let's not even talk about this requirement that you must track employees' hours, because if any employee is a part-time employee between 500 and 1,000 hours a year, that you've got to track that, because if they have between 500 and 1,000 hours a year for 3 consecutive years, you have no choice. You must cover them in your 401k plan. This is all administrative quagmire, things that small business employers absolutely don't want to have to hassle with. They don't want the expense. They don't want the complexity. Explain to them what the Secure Act allows them to do with this, and then go to them with another idea. Want a different retirement plan? Mr. and Mrs. Jones, you're running that family-owned business on that strip mall on the edge of town. You hire some part-time employees every year to help you run your business, but you really just want to take care of yourself. How do you do that? I got an idea. It's called a Section 162 bonus plan. What's that? Well, it's just a life insurance policy that you buy on yourself, and you use your business dollars to fund the premiums, just like you would have put your business dollars into your 401k plan. But this is even better, because as a life insurance policy in a Section 162 bonus plan, what happens? The money goes in on an after-tax basis, like it grows tax deferred like a Roth. There are no RMDs like a Roth. You can take it out during retirement, tax-free like a Roth, and the death benefit goes to your beneficiaries income tax-free like a Roth. So when your small business employer buys a life insurance policy and funds it using the Section 162 bonus plan privileges, there's almost no plan administration to this at all. There's almost no cost to this at all. But what does it create for your small business owner? It essentially creates a Roth 401k option for them at almost no cost. All they have to do is put the money in, buy a life insurance policy, and start funding it. And oh, by the way, if we use indexed universal life, you'll have upside market potential and no downside market risk. So if this client wants a retirement plan, but they really want to take care of themselves as the business owner, they don't want to worry about all their part-time employees, they don't want the complexity of a multiple employer plan 401k, introduce them to a Section 162 bonus plan, and they'll have one of the greatest retirement tools they can find. What a great idea you can offer. They also said in the Secure Act that annuities will be available as a 401k option. Now, this doesn't mean employers are required to make annuities available, but they can. That's what the Secure Act said. They can make annuities available as a 401k investment option. What they were trying to do here is to give employees the opportunity to turn a defined contribution plan into a defined benefit plan. You put your money into your 401k while you're working, you accumulate, you grow, and now you retire. You want guaranteed lifetime income. How can we turn your 401k plan into a pension plan? How can we create an environment where you have guaranteed lifetime income? You do that with annuities. So you don't really need an annuity as an investment option. You don't need a deferred annuity inside your retirement plan. What you need is an annuity that gives you guaranteed lifetime income. Well, you don't have to be in a 401k to do that. So this is what I would suggest. You have a client who's been participating in their 401k. They now want guaranteed income for the rest of their life. Here's what I would suggest. If you want guaranteed retirement income, give me that 401k. We'll do a rollover to an IRA. And then you know what we'll do? We'll buy a single premium immediate annuity inside of your IRA. That's all the Secure Act was going to do inside your 401k anyway, but take that money, put it in your IRA. Let me give you an example. You've got $1 million sitting in your 401k plan. You do an IRA rollover. You take $300,000 or $400,000 of that money and you purchase a single premium immediate annuity. That $400,000 will now give you guaranteed income for the rest of the life of you and your spouse that you cannot outlive. And you still have another $600,000 inside of your rollover IRA that you can do whatever you want with. Now you have guaranteed lifetime income. This is something that the Secure Act was trying to do, but generally speaking, investors don't stay in their 401k when they retire. They do a rollover to an IRA. And once they do, you can give them the same guaranteed lifetime income that they're talking about with the Secure Act. And you've given them the ability to turn their defined contribution plan into a defined benefit pension plan using a single premium immediate annuity. far less complexity, far less cost, totally guaranteed. So what did we learn today? Let's just do a quick recap. We covered a lot of ground today. Let's just do a quick recap, and then we'll do some Q&A and give away our Amazon gift card. We learned that there are 3 things increasing IRA beneficiary income taxes. What are those 3 things? Gosh, you've probably already forgotten. It's been 45 minutes since we talked about them. You probably can't remember any of them. What are they? The first one is the new uniform distribution table of factors. They reduce RMDs, which leaves more money in the IRA, which creates bigger inheritances, but also creates more income taxes. What's the second one? RMD age has been pushed back from age 70.5 to age 72. So there's 2 years of RMDs that now get to stay inside of that IRA and grow. And if this new update passes, there will be 5 years of additional RMDs that get to sit inside that IRA and grow. And that leads to larger inheritances, which also leads to more income taxes. That's where we talk about beneficiaries writing that check for an additional $80,000 of income taxes just because a $1 million IRA had the RMDs pushed back by 2 years. And the third one was the loss of the lifetime stretching and replacing it with the new 10-year rule where all the money's got to come out in 10 years and be taxed. Those are the 3 things increasing IRA taxes. We realize that with this new 10-year rule that IRA beneficiaries are going to give 10 years of growth back to the IRS if they just sit on that IRA and wait for 10 years to pay the taxes. We also learned 3 possible solutions. We learned about tax offset, where you buy enough taxes to hire or enough death benefits that you're essentially hiring the life insurance company to pay the taxes for you. Second alternative is the tax elimination strategy. Don't make it more complicated than it is. We're simply going to give the IRA to charity. Charity will pay no tax. We're going to give the non-qualified assets and the life insurance death benefit to the kids, and the kids will pay no tax. And the third solution was the spousal Roth conversion. I'm going to buy a life insurance policy. When I die, Mary's going to take our IRA, roll it over, do a Roth conversion, use the life insurance policy to pay the taxes, and then have a Roth IRA that she can enjoy for the rest of her life and that she can pass on to our children. We learned about a beneficiary alternative to a Roth conversion. So IRA beneficiaries can't do a Roth conversion, but if you split your inherited IRA into 10 equal parts and use it as a 10 premium payment into a minimum death benefit life insurance policy, you essentially create all of the benefits of a Roth conversion, maybe even more. We learned about how small businesses can use a Section 162 bonus plan to create a retirement plan for the parents that own the company rather than doing a complicated 401k multiple employer plan. And then lastly, for those employees that have a 401k plan that now have the opportunity to purchase an annuity inside their 401k, they're really just looking for the opportunity to turn a defined contribution plan into a defined benefit plan. And we can do that for them by simply doing an IRA rollover and then buying a SPIA, a single premium immediate annuity, inside of their IRA. So a ton of information to learn. Put some of this under your cap. Because the guys have recorded this for you, you'll have the opportunity to review this information and be able to get this into your vernacular so that you can start talking about the stories we tell, not the products we sell. Help your clients realize how you can help them achieve things in their legacy that they never imagined. And with that, I'll turn it back over to Neil. We'll take a look at if there's any questions that people want to ask, and we'll give away that Amazon gift card. Neil, back to you.
Hey, thanks so much, Joe. Boy, that's a lot of information to pack into, about an hour here, but what great planning ideas that you guys have with the Secure Act. With your clients. And a lot of these things the clients don't understand yet, and it's a great opportunity for you to present those to them. If you have any questions that you'd like to submit, go ahead and type those in the questions area of the GoToWebinar control panel. And we're going to flip over to the drawing here. All right. So everybody that's been on the call during the call is in the hat. We put all the names in the hat and shuffled them up, and you must be present to win. And before we get to that, this webinar will be posted on youtube.com/fmiAgent if you'd like to share that with some of your colleagues, or just want to go back and review some of the information we covered here. And with that, we'll go to the drawing. I don't see any questions here yet. Joe? So we'll have a fictitious drum roll, and let's see who our winner is. Todd Adrian. Let's see if Todd is still on the call. And Todd is on the call. So congratulations, Todd, on winning the $50 Amazon gift card here today. Hey, get in touch with your internal wholesaler here at Financial Markets. We'd love to design a 1% solution or a 2% solution for you to help your clients. And a big thank you to AIG and allowing Joe Ross to share this information with us here today. So thank you very much, Joe, and we'll end the conference now.